Okay. Good evening, everyone. This is Charles Kafel, and I'm going to be taking you through financial accounting. And without wasting more time, allow me kick off. But I'm going to be first handling the theoretical part of it, so that by the time I take you to the calculations, you will be knowing what exactly are we looking at when we say we are starting financial accounting. And in this video, I will let you know and I give you more details about financial accounting, and the emphasis is going to be on the definition of financial accounting, what constitutes financial accounting as in the components which lead to the process of accounting of financial statements. Having given you the components, I'm going to take you through the branches of accounting. After knowing the branches of accounting, the next thing will be the forms of business entities, which we are going to be dealing in when we are preparing the financial statements. So allow me kick off without wasting time. What I can only say to those who are new to my channel, I can only say that if you're looking for a channel where you are going to learn accounting, it's better you subscribe, and you can even click the notification bell icon so that you'll be getting updates on whatever information about accounting I'll be posting. Because by subscribing, you are not only helping the account to grow, but you are also getting more and more information about what is really happening, as in the videos I will be posting in the due time. So allow me proceed. Okay, the first thing is, what is financial accounting? But before I take you there, we need to first know what really accounting is. Accounting is the process of identifying, measuring, and communicating economic information to perform informed judgments and decision-making by use of that information. Accounting is all about, accounting is not a one-way process. It is a process. It is a continuous process whereby it has some steps which you have to follow so that you can be able to get the information and analyze that information so that you can present it for decision making to the management. So as I said, accounting is the process of identifying, measuring, and communicating economic information to perform informed judgments and decisions by users of the accounting information. because when we are recording the information, we record it in the books of account. Those are the source documents. Having known which books are we supposed to record the information we got from the field, or when we are transacting, then we shall also measure. By measuring the information, it's like we are touching the value, because financial statements are presented in monetary terms. So by measuring, it's like we are trying to analyze, we put the cost, we put everything together so that we can get the value. Having got the value, then you communicate that information so that we are communicating the information. First of all, we communicate it to the management. Those are the internal users, management, and let's say the directors, for them to make a decision on the day-to-day running of the business, as we shall see. Then allow me proceed to financial accounting, because accounting itself has branches, and one of the branches of accounting is financial accounting. So financial accounting is the art and science of recording and classifying financial transactions in the books, summarizing and communicating financial information through production of financial statements. As I said, this is, if you know what accounting is, then when I attach something like financial term, you will be understanding that we are dealing in the monetary value of whatever transaction we are dealing with. But it is also a process whereby you first record the information. By recording the information, you have to classify, because when you record everything, whatever transaction you make, you make a recording in those source documents. But having recorded those raw facts and figures, you have to classify them depending on their similarities or their groups, for those having group names. Having classified the information, you make sure you summarize, because when you're communicating the information, it has to be in a bit of a summary, so that even the person who doesn't understand accounting can get a clear picture of what you are really up to. Having summarized the information, then you communicate the information. When you're communicating the information, of course, the users, for them, they just expect to know how is the worth of a company. Is the company able to pay the employees? Depending on the information on the people who, or on the users who need that accounting information. So we communicate to them through the preparation of financial statements. And these financial statements are our income statement, can call it trading, profit and loss, trading or profit and loss account, or a statement of comprehensive income, and statement of financial position, that is the balance sheet, plus a statement of cash flow. Those are the statements we normally present to whatever department that needs that information, and whatever reason they want to do with the information we are providing to them. So that's the role of an accountant. It's to prepare, you just prepare, then you leave the rest to the management so that they can make the informed judgments. Okay, the second thing, allow me go a bit and clarify some of these items as we spoke about them when we are defining financial accounting. One of the things we said, financial accounting includes recording accounting data. Recording accounting data, here we mean the transactions we We have the details about transactions we've recorded in the books of accounts. So this is the process of recording data relating to accounting transactions in the books, or in the accounting books, or in the books of original entry, or the source documents. And that process is called bookkeeping. It's just a matter of recording those raw facts or writing those raw facts depending on whatever transaction you are doing. If, let's say, you are buying goods on credit, if you buy goods on credit, we are supposed to receive, how are we going to acknowledge that? By receiving an invoice, that we've got an invoice of this amount which we purchased on credit. If it is a cash payment and you're paying some expenses, we expect to be having a receipt of what you really paid using the cash. So that's what they mean by saying recording of accounting data. The other thing we said, accounting involves classifying. What are we classifying? It is a bit difficult and necessary to record all the details of every transaction. For accounting information to be understandable to users, items need to be categorized or classified. For example, I can say, like, if I'm communicating this information to someone who doesn't understand, let's say, accounting, let's say I'm explaining to the public, what they really want to know from our financial statements, for them, they want to know, is the company really going to make goods available for us? And if so, are they going to be charging us highly, or they are going to be charging us a less amount of money, depending on the profitability of the business? Because if the business can make a lot of profit, so you expect at least not to charge or to overcharge people. So the public will look at the statements in that point of view. And in the other point of view, they can look at, is the company really able to provide for us corporate social responsibilities? Like, you can, are you really concerned about them, or you are just there to make profit? So those are the things the public will be looking at, but not forgetting that some of those people, they don't even understand what you really put in the books. So for them, they want something which is a bit categorized or summarized, a bit class. You don't give, like, when you're giving, you don't give so many things. You can specify some of them, and some of the examples we can say, like, chairs and tables are recorded as furniture. So you can say, I bought chairs and I bought tables worth, let's say, 10 million. So instead of saying I bought chairs, tables, we can only say I bought furniture of, let's say, 10 million. The other thing, you can talk about these pens, pencils, books, those ones. You can generalize them and you call them stationery. That's what they mean by classifying the accounting information. We talked about summarizing accounting information. In a period of in an accounting period, a lot of data, a lot of accounting data will be recorded. The users of accounting information will not be interested or even have time to study the details of all the data that has been recorded. So if you want to really communicate something and the person you're communicating to doesn't, let's say, understand the accounting principles and rules, you can try to find a way of making it simpler for them by just giving them a rough figure. Someone may instead of telling someone that I sold these goods and I had incurred this amount. So for them, what they want to know, they want to just know, yes, if you sold these goods, what profit did we get from there? Or if I gave you some money to buy certain commodities, what is the balance you have at hand after purchasing those goods? That's how we mean by saying summarizing the accounting information. Then the other thing is communicating information. For accounting information to benefit the different users who need it, the parties need to have access to that information. It is a duty of an accountant to produce financial statements and present them to the users of accounting information. So it's the same thing like what I said. If you have collected the information, you have analyzed everything, and you have presented the reports or the financial statements, so they want you communicate to the people who need that information. Maybe it may be the management for decision making, it may be for the shareholders, because having made those financial statements, someone will just look at the company and says, so this company has made this profit, so I'll be able to get my dividends on time, depending on the policy that is in. But if someone sees that the company is really doing good, then there you've communicated the information. And I think that's all you guys should know about financial accounting. It is not a one-way process. It is a series of different processes which those accountants go through so that they can present to you the financial statements as you see them. Having known the definition of financial accounting, allow me proceed to the branches of accounting. Remember, we said financial accounting is one of the branches of accounting. So the other two branches of accounting are cost accounting and management accounting. Sometimes they combine them, but they are a bit different, though they are a bit similar, but they have their differences. Cost accounting, this is the process of, this is the branch of accounting concerned with the determination and allocation of costs to products or services of a business organization. So cost accounting is only interested in the allocation of those costs and the determination of those costs of the products. For them, they just look at, if you want to know how much did I spend on producing those goods, there the cost accountant will be in charge of determining the raw materials we've used, the labor, the direct expenses, and other production costs that has been incurred in the production of those goods. So for them, the cost accountant is only there to provide information regarding costs. And that information is provided to the management for decision making, because after having made those documents, so what's next? The management will expect you to take those reports and try to explain to them, so that for them they can make a decision on whether to add a certain component of profit, because they can use that. If you've got the cost, you can know the selling price of the item by adding a profit component on the cost. So the other one is the management accounting. Management accounting deals with with analysis and interpretation of accounting information. It provides management with the information for internal decision-making concerning daily operations. So you've seen the difference. The other one, of course, is just considering the cost, but this one you analyze everything. You consider the financial statements, you consider the cost statements, then you make a decision. And the most important thing about the role of a management accountant for him is just to make a decision on depending on the information the cost accountant and the financial accountant they have presented. If they say this month we made, let's say the financial accountant is reporting, let's say we made a loss. Let's say in our cash flows we have some adverses of which you cannot sustain the business. You cannot sustain a business when you're running, when the operating capital is in negatives. So you have to look for ways of how you can finance those day-to-day running operations. And that's all about the branches of accounting. But don't forget whenever they say, because sometimes they ask the differences. What are the differences between financial accounting and the cost accounting? Or what are the differences between financial accounting and management accounting? You can just categorize them and you say some of them, like management accounting is only interested in getting those financial statements and analyze them so that to make decisions. But the other side, for them, they just present depending on whatever scenario you wanted. If let's say the management accountant wanted a financial statement, then the financial accountant will just present that to the management to take actions, because you analyze everything that is presented in the documents, and you find a way of how you can control. You can either be controlling costs and so many other things. So when you're reading, make sure you try to look for those differences between those three, because the difference is always there. You can even generate it in a different way by just categorizing them. You say for the purpose of the information, that will be a difference. So purpose of the information, what is the need? What do they need for the cost statements? What do they need when they are preparing management? What are they up to when they are preparing those statements? You can even talk about the users. Like cost and management accounting, those are used internally, but the other financial accounting statements, some of them are used externally. Those are some of the differences. Even their way, how they are prepared. You may find that financial accounting has its own formats which you are supposed to follow when you're preparing those financial statements, which is not the same way like for this cost and management accounting. You can even base on the period that these ones are needed at this particular period, these ones are prepared at this particular period. So the differences, they are always there. I've just wanted to just give you a brief view of what you may find in the question paper. Allow me proceed to the forms of business entity, but I want you to first understand what is a business entity or what is an entity. An entity is a thing which exists separate from other things, or it's something which exists separate from other things. In financial accounting, it refers to the existence of business separate from its owners. Since in financial accounting we are only dealing with those businesses and what transactions they do, a business is supposed to be separate from the owner. Like if it's not that whenever I have a business, I'm supposed to be connected to the business directly. Though some cases have that mean, like for the sole proprietor, when the sole proprietor dies, even the business dies. But in financial accounting, we are saying the entities, the business entity should be separate from its owner. By the time the owner dies, the business must stand. That's the interpretation. So the main forms of business entities we are going to be talking about here are the sole proprietorship, partnership, and the registered companies. We can even add some other businesses like departmental stores, those ones, but the emphasis is on these three: the sole proprietor, the partnership, and the registered companies. Because even the other departmental stores, you may find, for us, what we are looking at, how are they operated? Is it owned by someone, or it is owned by other people? So we are on that side of the ownership. So allow me proceed, but I want you guys to go ahead and try to look for the differences between partnership, sole proprietorship, and registered companies. You compare those three, you see the differences. Like you can talk about, like for a sole proprietorship, as we say, the ownership. When the owner dies, the business also dies, which is not the case with other businesses like the partnership, because partnerships also, when the partner dies, they have a way of how they can recruit or how they can compensate the partner who has died. And even for registered business, for them, they are safe, because even if you try to sue them, you can even talk about the liability that these two, the sole proprietor and the partnership, some partnerships have unlimited liability, whereby if the business is winding up and there are debts, they have to look for money to pay the debts the business is having, which is not the case with the registered companies, because some of them they have limited liability. So allow me proceed to the means of financial accountability. Here we are talking about the documentary evidence, or the source documents, the ones we use when we are recording the information. Having gone to the field and you are making some payments, you will be moving with some documents. Like if, let's say, you are giving out, you are buying out some, you are buying some items. Of course, if you are paying by bank, sometimes you go with the car, you go with the cash. Others, they just use the bank and they use the checks. It depends on whatever you are going to do. So what I'm going to be looking at, these source documents, they are the one is like, it's like a backup. If someone says, yes, I bought this and this and this, someone will just say, where is the proof? So these are the documents, where we record the information. That is the first-hand information. So the first one is called a receipt. This is a document prepared to acknowledge that cash was received. It is usually prepared in duplicate. The original copy is issued to the client, while the duplicate is retained by the organization for accounting purposes. When you buy goods and you pay by cash, of course, we expect to receive the receipt. The reason as why we have to receive that receipt, we want to confirm the actual number of units you've bought. We want also to confirm the price, because someone may say, those goods you are seeing there, I bought them 10 million. So for the accountant, it is not enough. Someone will say, yes, you paid 10 million, but can you break it out? And you tell me that I bought this quantity with this selling price. And why did you make a decision to buy it? Were there no cheap sources? It depends on the situation. So if you are to confirm that you are safe, what you are telling is true, then you present a receipt. The other document we can talk about is a voucher. A voucher, it is just evidence of payment made. The difference between a voucher and a receipt is that for the voucher, we are not supposed even to prepare it in duplicate. We are supposed to be having only one copy, because we have already paid out the money. So there is no need of the company remaining with some backups, because we are giving you the voucher to go and pick the goods where we paid them. This one always happens, let's say, when the company is giving out gifts and some donations. Like even these other incentives, some companies can just say, you know what, you have this voucher of, let's say, 1 million, and go and buy some goods from, let's say, a supermarket. Having paid the money to that supermarket, the person who is receiving that voucher just goes and buys goods from where they paid that amount of money. So the only challenge with this voucher is that when there are some instances whereby you are not supposed to receive balances. It's like if you go with a voucher of 100,000 and you buy goods of, let's say, 9,000, they are not supposed to give you cash. Like the difference, they will just tell you, you pick other goods which can completely finish the voucher you have. Allow me proceed to the other source document, which is an invoice. An invoice is a document received or issued by an organization demanding payment for goods supplied on credit. As I said, if you don't pay by cash, we expect you to come with an invoice if you have purchased goods. It specifies the quantity of goods, the units, that is the unit price, the discounts, if any. Remember, with the discounts, we are only writing the cash discounts. We don't write the trade discounts. Trade discounts are not recorded anywhere in financial statements because you have not actually paid for that money. So that's why trade discounts are not recorded anywhere. We said discounts and the amount to be paid. Allow me stop here for the source documents. I know you can add on more because there are more. I know there are more, and we've just spoke about few, but I know you can go ahead and research more about them. My emphasis is just to give you a highlight of where we get the information before we make it into our financial statements. Allow me proceed to the importance of financial accounting. The major or the primary objective of accounting is to provide information for decision making. That is the major point. Because at the end of the day, when you prepare the financial statements, what you want to know whether the company has made a profit or it has made a loss. Is the company capable of paying it or paying the debtors? I mean the suppliers. Those are the things we want to know. That's why it is the main objective is to provide information for decision making, because when you get that information and you know, we are demanding at the end of the year, we are still having this balance, let's say, of creditors. We are still demanding these people some amount. There you can make a decision on how they are going to be paid and how the debtors are going to be paying you. You can do that through this cash budget. You make analysis. You forecast how are they going to be paying you depending on the terms you had with them when you're giving them goods on credit. Then the other thing, we can use also the financial accounting information as a basis for planning. A business as well as a non-profit organization formulate its plan, including financial plans, in bracket budgets, from accounting records. You base on what you purchased last year, then you can base on that and say, this year we may be having this one, because since it is a forecast, you are just forecasting what will happen in the future. You will, based on the previous information, that let's say raw materials for the other month I bought this amount, so you forecast it and you say, for this coming accounting period, I may use this amount of money, because you already paid some goods last time and you have those documents. The other thing we can talk about, it is a tool for control. By comparing actual with the planned figures, organizations will be able to determine the deviations. As such, take corrective action in time. When you make a forecast, you will compare that forecast with what actually happened, because you may say, I'm forecasting that, let's say I'm estimating to produce 10,000 units, but at the end of the accounting period, you find that you have produced, let's say, 9,000 units, or you had planned for 10,000 units and you have produced 12,000 units. So it depends. By that, you compare the information that you forecasted with the actual, and you see how, if let's say you had planned to incur less costs and you find out that you've incurred more costs, then you find out how to control those costs and how they came about. Then the other thing, it can be monitoring performance. When you prepare those financial statements, we expect to know how the company performed in the full financial year, because owners base on that for the evaluation of the managers or the management. They can just base on that information. When they know that the company is not making profit, so it's these managers who are not doing who are not doing their job. So if they are not making profit, then the job security of those managers is also at risk. So the other thing you can talk about, facilitation of credit transactions. Accounting records helps to determine amount due to creditors or due to debtors. You can base on some of the source documents and say, this amount and this amount was unpaid at the end of this period. So by that, you know where to start from next month. If you want to get another credit facility, you'll be knowing how you really paid what they had given you first. Allow me proceed to the next slide, where I'm going to be talking about the users of accounting information. The users of accounting information, you have two main users of accounting information. You have the internal users and the external users of accounting information. So for the internal users, those are the users within the organization. So they need that accounting information for what? When you are looking at the users of accounting information, we look at them as, let's say, they are managers. But what do managers want from this accounting information? We have to find the users themselves and their interest in the accounting information. So when you find a question and it is asking about the users of accounting information, don't just give managers and you stop there. What do managers want from the accounting information? Their interest. That's why when you say, like, for internal users, we have the managers. These are the day-to-day decision makers. They need to know how well these things are progressing financially. In other words, the managers, for them, they want to make decisions. So they want to find out, is the company making profit? If the company is doing well, then they are also sure of their job security. They are sure that they can pay dividends to other people. They can pay to the people who are owing, who owe the company. The other thing we can talk about for the internal users of accounting information, we have the employees, stock trade unions. These employees, for them, their interest is about, is the company really making that profit which can help them pay our salaries? If so, then are we safe? Are we having job? Is there job security? Because if you are working for the company and the company is reporting losses every month, if it is not, if the losses are not doctored because they want to go away without paying taxes and they are really making losses, you expect there is no job security there, whereby they cannot even improve your working conditions by providing the basics which are needed to do your job well. The other thing we can talk about, those are the external users. The external users, the first have the shareholders or the owners of the business. The owners of the business, for them, what they are interested in is to know whether the company is making good profit, which can help the company to pay their dividends in time and when needed. If the company can do that and it can pay the shareholders their dividends in time and they give them what really they deserve, the owners and the shareholders are satisfied. That's why they need to know the information about the statements of the company. The other thing we can talk about, those are the customers or the prospective buyers. I'm giving these answers when I'm separating them, but you can just give them as separate. The way you explain matters, because for the customers, these are the people who buy our goods. What do they want from us? They want to know, is the company making good profit so that it can give us goods on a fair price, or it is not? It is going to be overcharging its products. These prospective buyers, you can talk about them in terms of the people who want to buy the company. If the company is going to be sold, someone can look at the financial information and says, no, look here, you are saying we have goodwill of this amount, but when you compare the profits you've been making, it doesn't really make that amount you are saying, and the actual cost you want this amount, but when you base on what you have been doing, it is not worth it. So the third one, we can talk about the financial institutions stroke banks, and you can also include the creditors, but you can separate them and you give their different explanation, because the financial institutions and banks, for them, they give actually cash, but these creditors, those are the people who give who supplies to us goods on credit. So what do they want from the accounting information? They want to know whether the company is making a good profit and it can be able to pay its debts on time, or not. Then the other thing, we can talk about the government or the tax inspectors. For them, what they really want to find out is that, is the company making a good profit so that it can give us our taxes? If it can pay its tax liability or obligation in time. Then the other thing we can talk about is the general public and the competitors. These partners, even if I skip them, those ones and investors, you can know, because for them, okay, let me talk about them. Prospective partners and investors, for them, they may be looking at the financial statement in just a view of when they want to make more investment in the company. So they look at them and they see how you've been performing, so that they can determine whether to take the offer, whether the offer is viable or not. Then the competitors and the general public, as I said, the general public is interested. Are you not polluting the environment? Yes, you are there to make profit, but are you not making profit at the cost of us? Are you doing the social responsibilities that is needed in the place where you are operating? These competitors, for them, they want to know whether the company is making profits and how do they charge the costs. What are some of the techniques they are using to get more customers? So in order, you can talk about those ones, but when you're talking about the users of accounting information, make sure you put their interest. Don't just say they are shareholders. So what do they need from the financial information? That is really important. Allow me proceed to the regulatory framework or the accounting rules. As I said earlier, that this tutorial is basically a CPA tutorial, or it's going to be concentrating more on what is really done in Uganda. But since you know CPA is a global, it is globally recognized. So what changes, the explanation I may be giving may be different depending on where you are, because when these regulators of the people who are setting these accounting standards, when they do them, they base on the laws which are existing within the country. So it is just the laws which are changing, but the principles and everything, they are the same. So when I talk about the regulatory framework or the accounting rules, these are the rules that govern professional accounting practice. These are the rules that govern professional accounting practice. They are imposed on accountants in order to ensure their reporting. The reason as why they said these standards is that when you're preparing those financial statements, don't just base on any rule from anywhere. So that's why they said those standards which guides the accountants on how to prepare certain documents, like preparing the statement of financial income, balance sheet, and everything, whether you follow those standards. You can say preparation and presentation of financial statements conform to the generally accepted accounting principles. But there are so many things. I just did just a highlight, because when you're talking about the regulatory framework, I have to start from where it started. But I'm just pulling out some key things which I need you to focus on so that you can really do better with them. The other, we can talk about the generally accepted accounting principles. That is the accounting principle and practice that recorded permissible by the accounting profession, which is the one guiding how these statements are supposed to be presented. So the regulatory framework includes the accounting concepts or principles, accounting bases, accounting policies, accounting standards. In all of those ones, I'm going to just highlight like 2 for accounting standards and accounting principles or concepts. But for the accounting concepts, those ones are going to come in the next video, which will be coming in soon. So when I explain the accounting standards, just know we are going to stop here for today. Then in the next video, we shall be handling the accounting concepts, stroke principles. Accounting standards, these are guiding statements or rules issued by professional bodies governing practice relating to how accounts should be prepared and presented. In Uganda, the professional body responsible for issue of accounting standards is the Institute of Certified Public Accountants of Uganda, and it is designed to comply, and they design those standards to comply with the laws of the country. So with that, allow me to stop here. And in the next video, we are going to be handling the accounting concepts. We talk about them, the business entity concept, the matching concept, prudence concept. Those ones we are going to talk about them in the next video. So I hope you guys have benefited a lot, and I really want you to subscribe for this channel, because we are going to be receiving more and more and more in the preceding videos, because I've tried today to make something theoretical so that you can get to know the concept before we start handling the calculations, because I know everyone is waiting for the calculations, but don't worry about the calculations, because those ones are very okay. But I want you to first grasp the concept of financial accounting from the start. That's why I'm also going ahead to give you the accounting concepts, because if you know the concepts, you are very, very, very good to start everything when you really know where you are heading and where we are going to stop. So thank you for watching, and God bless you.